Welcome back, everybody, to the Teaching Tax Flow Podcast, episode 139. Today, we are looking at tax strategies for business owners earning over $150,000 per year. Now, this episode, we're not going to tell you how to earn $150,000 per year, but we are going to give you some tax tips, hacks, and strategies to help you keep the most of that $150K as possible from the IRS. That's right, your involuntary business partner, better known as the IRS. So let's dive into this. Me and Chris are going to have a fantastic conversation around these strategies. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
Hey everybody, we are back here again on the podcast, and today we are going to dive into that title that you see in front of you. We are going to look at tax benefit strategies for business owners earning over $150,000 per year in verified. Let's put verified income in there. And as always, Chris Pacuro, welcome back to the show, sir. You're the co-hostess with the mostest.
Oh, it's great to be back. Of course. How are you doing today?
Doing good, man. Doing good. I'm excited about this topic, as they all are, because we both have to approve them anyways. It's not like we just throw these out, but This applies to a ton of people, right? And let me ask you this. What is significant about that 150,000 mark? Like, why did we choose that 150?
Well, there's a few reasons. First of all, I think at $150,000, just by percentages, it seemed that would be kind of a higher income household here in the United States. And then a business owner earning more than that typically is going to have some type of financial resources to do tax planning and strategy. At that point, they typically are in a situation where they've made it through just paying the bills, surviving, and their business is probably growing, and they're looking to implement things. Because a lot of times when you're growing, even though you might have a profit, you're investing all the money back into your business, and which is a whole nother issue. But that's your marginal tax rate starts to creep up quite a bit, regardless of your filing status. You know, at $150,000 in net income, assuming you're self-employed, you're filling up a lot of that Social Security wage base and getting into that higher marginal tax rate. So it's a combination. When you talk about tax planning and strategy, it's not just what your income is and what your marginal tax rate is. It's, do you have the financial resources to do any type of planning or strategy? Yeah. So someone might say, I want to contribute to my retirement plan, but they're spending all their money from their business. Cue Mike Reed up. I'm sure he would, our friend, a CPA, and does a bunch of CFO work. Understanding where all that money's going is one thing. So sometimes you're spending, as a business owner, if you have a profit of $80,000 and you put that money back in inventory, you're in a tough spot because you don't deduct inventory until you sell it. So you've got 80 tax span, 80 grand, and you have no cash left. So managing your cash flow is important. And then once you get to $150,000 or more, that's where you're typically in a good position cash flow wise, and you could really think about some of the things we're going to talk about.
Right. And really, from probably one of the first episodes we've done, there's been a good trend, I think, that's followed every one of those. Actually, we'll say multiple trends. One of them being that tax planning and strategy is not just for your ultra wealthy, ultra high income earners, right? Like, people might hear that and they say, oh, well, that's for people that make $1 million plus, $5 million plus. It's not the case. But then also, we talk literally probably every episode, or at least every other one, about really the benefits of being a business owner, but taking out the stress and the other stuff that you get sometimes. But then when it comes to taxes, right? If done right, planned right, you're educated, or at least you have the best people on your team, really the ball is in your court to almost tell the IRS what the bill is. They're not just going to send you one and say, "Oh, slap you with it and you're done with it." You have a lot more control over it, right?
If you want to do the planning, absolutely. And the cool thing about a business owner is that you're paying tax on your net income, not your gross income. So that's where where there's some planning opportunities. So yeah, so once you get to over that $150,000 point, I think your needs change and your ability to implement changes. I agree with you 100%. There's tax strategies for all types of different income and asset levels. Mind you, when you're in the lower to moderate income levels, typically you're not going to see too many tax advantage investments implemented. You're not going to see too many tax mitigation strategies implemented. Most of your tax planning is going to be very behavioral, which still can be very effective. So that's something to understand that we even at Teaching Tax Flows have really been breaking down, that there are 3 types of tax planning implementations: behavioral, tax advantage investments, and tax mitigation strategies. So once you start having that income go over 150, you're going to want to take care of those behavioral things, the things that we know you should be doing. A lot of times behavioral strategies are rather a little more basic, a little easier to implement on your own into those tax advantage investments or tax mitigation strategies. So yeah, let's talk
Perfect.
through this.
Perfect.
What we should be thinking about
Yeah.
at that 150,000 or more.
Absolutely. And it is a good number too, because you mentioned a little bit earlier on too, and maybe before we jump into that, you can give us the Crispicuro professional definition of what a marginal tax rate is if somebody's not familiar, right? Because I think we all kind of grew up with, obviously the number was different 20, 25 years ago, but once you get to a certain number, your tax bracket changes. So tell us really quick, MTR, marginal tax rate, and tax bracket, are they the same thing?
Right. No, they're absolutely not the same thing. Well, your marginal tax rate, as we know in Teaching Tax Flow, we have 3 laws. One of the laws is that tax agencies are your involuntary business partner. So what that means is that with marginal tax rate, for every dollar of taxable income you report on your tax return, that legally and ethically required to report, what percentage of that goes to your business partner? That could be the IRS, it could be a state, it could be a city. That's your marginal tax rate. Conversely, every dollar that you protect or don't have to pay tax on in the current year, how much are you saving having to pay? So if your marginal tax rates, there are people in lower income situations that have a 50% marginal tax rate. And you might say, that sounds ridiculous. It's absolutely possible. If let's say you're self-employed, you are potentially qualifying for a retirement savers credit, maybe an earned income tax credit, child tax credit. So when you talk about credits, those play a role in marginal tax rate.
Awesome.
Or
Awesome.
another credit in the situation where you maybe are in the lower to middle income situation is the premium tax credit. So let's say you expected your income to be $40,000-$50,000. You have insurance through the what we call the marketplace, and the government is basically subsidizing that entire insurance premium. It could easily be $1,500 with a family. And let's say instead of making $40,000 to $50,000, you had a great year and now you made $100,000. You're going to owe all of that back. You're going to owe all of that subsidy back that given year. So again, your tax bracket's static. Marginal tax rate is not static.
Perfect. Perfect definition. And thanks for going over that, because I know some people, they may not have heard that, and they may be so fixated on that tax bracket, right? Like, and that's the number. So that's why when I thought of, I used to think, again, a while ago, that like 125,000 or 127, whatever it was, I think was where it kind of jumped a little bit. But either way, let's get into this for those business owners that are out there. But then also, I think this is a great episode for somebody that's thinking about doing it, right? Or they just started, they're not making a lot now, but obviously the intent is to grow. So you kind of know what to expect. So let's dive in head first off the diving board.
So let's dive in on some of these strategies. So we're going to start with behavioral strategies. When I say behavioral strategies, that means that it's a strategy that you can implement that doesn't necessarily cost you any money out of your pocket. It's just something that you either report on your tax return or track properly. So as a business owner, many business owners, I would almost argue that a majority of definitely gig economists, et cetera, gig workers, a lot of them work from home. And we should not be afraid of the home office deduction. The home office deduction could be extremely valuable. And if you qualify for the home office deduction, yes, we have a separate podcast episode just on that. So we're not going to dive into all those details. But let's say you qualify, you have that opportunity to take the simplified method or actual expense method. But one thing to understand why home office deduction is very important is that commuting miles aren't deductible. So if your home is your primary business location, then every time you leave the home to drive somewhere, those miles are now deductible. That's why, and so if you have a legitimate home office, you should absolutely take that deduction. You are paying for your home office. Either you're paying rent or you're paying a mortgage payment or you're paying utilities. You're paying anyway. So when I say it's behavioral, it doesn't cost you any more money to take the home office deduction. It's simply tracking and reporting it with your tax professional. However, it could reduce your taxable income significantly. So the home office deduction is something that's really easy and important to take. It's not easy necessarily, but it's important to take as a deduction if you qualify.
Awesome.
So
And that too, I think we've had a lot of discussions with it. And people, I mean, a home office does not need to be, right, a wing that you've added onto your house with a separate entry, separate power source, all this stuff.
right.
I mean, I think we even brought up the example way back in the day. You could be an Uber Eats driver and you have a space in your home or apartment. It could be a closet where you sit down, you utilize that as an office. You keep some materials in there, whatever you designate, right, is your um, primary use for business purposes, right?
And it has to have exclusive use also. But
Exclusive use.
absolutely. So home office deduction, definitely something you could take now. Being the home office deduction is available not just to people that are self-employed or single member LLCs, tax as disregarded entities. Home office is available to C Corps, S Corps, partners and partnerships, or members of LLCs. Again, check out the Teaching Tax Flow YouTube channel. We have a breakdown of every type of situation and how you take the home office deduction based on each of those. So I actually remember recording those with you, John, in Indiana after teaching a class for 8 hours. And we said, we're still going to explain this. So we whiteboarded it out and we wrote that down. So absolutely home office deduction. The second thing someone with $150,000 or more of income should be considering, someone self-employed, are retirement plan contributions. Now, I'm going to preface this by saying, if you have employees that you have to really talk to a licensed financial advisor. You should be talking to a licensed financial advisor anyway, to make sure that the contributions you make are allowed. We can't exclude employees, and there are different rules. So, like for our company, quite frankly, we have awesome team members. And we want to contribute and we want to match some retirement contributions. We wanted to keep our administrative costs relatively low. So we chose to use a simple IRA plan. And so that worked for us. If you don't have employees, or if you have, so it comes down to, do you have eligible employees, of what type of plan and how much money do you want to put away into retirement? What makes sense? But the point is, retirement plan contributions, let's assume most people don't have employees, especially when you're just getting started. That's behavioral, right? If, let's say you're a business owner and you have $150,000 worth of profit, let's say you have some money sitting around in your business account at the end of the year. It doesn't even have to be at the end of the year. The nice thing with the retirement contribution is you typically have until you file your tax return to make a contribution for the previous year. And you say, I made $150,000 last year. I want to put $20,000 away into retirement. You take that $20,000, you take it out of your business account or your personal account, you contribute it to a retirement plan. Let's just say you're making a SEP contribution. You still own that SEP. You still own that $20,000. So why that's behavioral, there's still assets in your purview. They're still in your personal on your personal balance sheet. However, that $20,000 that you shifted from one place to the other is now a tax deduction. So if you're in a 30% marginal tax rate situation, that $20,000 reduced your taxes by $6,000, and you still have the $20,000. So it's an example of, again, a more basic strategy or behavioral. Now, retirement plan contributions could be anything from an IRA, traditional IRA, to a SEP IRA, all the way to a very complex complex defined benefit plan or cash balance plan. That's where you're going to want, we talk about this all the time, John, is making sure you work with your personal board of directors to ensure that you are doing things the right way. And, you could be the best driver in the world, perfect driving record, safe, efficient. But if you take a wrong turn out of your house, you could be making a lot of problems for yourself, right? So, got to
Absolutely.
make sure you're
And yeah,
on.
that board,
We
that
that board of directors is kind of like your GPS.
exactly. And they really are. It's basically your guiding light, but also let's just call them like accountability partners, right? It kind of keeps you on track from doing things people's mamas may have said back in the day, don't do a dumb thing. Like don't do stupid things over and over again. Because sometimes, right, as business owners, and I'll speak as one of them transparently,
Mhm.
sometimes what we're talking about here, you hear it so much, but yet you're like, I have no time to focus on that. I'm trying to run, manage, grow, and keep my head above water with day-to-day operations, right? But unfortunately, if you really step back and look at it, let's just give it a number. Say it takes you 10 hours to do
Mhm.
what we're talking about here, which just throwing it out there, it's going to save you so much of your hard-earned income that you kind of got to put two and two together and pick your battles, right?
Absolutely. You've got to be efficient with your time and resources. Um, let's talk about something that now is somewhat behavioral, also. And I think actually the next two things are sometimes overused or misunderstood. Okay. First thing is going to be your income shifting strategies. Let's start with saying income shifting between family members. We're going to talk about income shifting between related business entities at the end of this podcast, but income shifting between family members can be a really tax efficient way to plan. So let's say you're a business owner and you have a spouse that works in the business, and it makes sense to pay that spouse a small wage. Now, that alone doesn't save you any money. However, that could play a role when that's paired. Remember, our strategies don't like they don't like to dance by themselves. They like to be paired and stacked. That could be paired with a retirement plan contribution or a medical reimbursement plan, a Section 105 plan. So there's a lot of things going on. Or paying your children. If your children are doing legitimate work for your business, it would most likely behoove you to pay them a reasonable wage for what they're doing. And think about this: if your marginal tax rate's 30 something percent, and you have, a 15-year-old, like I've got a 16-year-old, 15-year-old, and 12-year-old. They've all helped me with our business in one way, shape, or form. So paying them a reasonable amount for what they're doing is fine, and their tax rate is much, much lower than our marginal tax rate. So that's where you want to start considering it. I'm not saying this isn't your flash, boom bang being TikTok or Instagram reel saying, go pay your kids exactly the standard deduction amount and you get a tax rate. It's not that easy. You've got to do things the right way. It's just like you can't go, yes, I'm going to use that car example. Let's say we're trying to get down to Florida and we already know we want to go south on 75 for a guy like you living in Michigan. And we want to use a GPS, but you can't go steal a car, right? That's bad. You've got to use your own car or have access to a car that someone authorizes you to do that. So, so the point is, and one of the reasons is to be transparent. I always hesitate to do these kind of episodes is that so I don't want things taken out of context. But again, income shifting strategies to family members could be super effective, either spousal or children, or sometimes parents. Let's say you have a parent that's retired, has a very modest amount of income, low marginal tax rate. They help you with the business. Could be doing some administrative things. I've got a client that we work with in teaching tax law that's an estate planning attorney, and she has her mom helps her out with the administrative stuff, and she pays her mom a reasonable wage, and everyone's happy. And we're moving things from a 35% marginal tax rate situation to 12%. So
Yep. And I see it a lot too. I mean, just in conversations with friends and other people out and about, it's almost like there's been, I wouldn't say a shift in workforce at all, but there's so much opportunity. I love that you brought up, parents. or other people, aunts, uncles, people that are older than you. You know, it's some people might have a hard time grasping that. Be like, well, why would I pay them, or why would that benefit them and me? Well, some of these hobby businesses, right? They just kind of popped up. They might have a father-in-law, mother-in-law, mom, dad, somebody that's not working.
Mm-hmm.
And you said, right, they're helping out with the admin stuff. I mean, they could be packaging shipments of printed T-shirts on the dining room table, ideally in a home office, though, for exclusive use. But right, there's a lot of opportunity with that, and it's knowing that these things exist is what makes all the difference, right?
Mm-hmm. Absolutely. Let's talk about the next one. This one is a hot button issue, as you know, for me. I think that as I talk to a lot of other tax professionals, it's the most overused strategy
Oh, I
is,
know what we're talking about here. I can feel it.
yes.
I can feel it coming.
Now, if you're over $150,000 in net income, it is a strategy you need to consider, okay? And that is potentially making an S corporation election or becoming an S corporation. Obviously, if you're self-employed, remember, you don't form an S corp, right? You either form an LLC or a corporation, and you elect to be taxed as an S corp. Typically, it's going to be an LLC. A lot of consideration has to go into this decision, including the compliance costs, the additional time to be very much more organized, the time to the determination of what you're going to pay yourself as reasonable compensation. Yes, on a W-2. So S corp owners that are involved in running their or working in their business need to be paid a reasonable compensation on a W-2 form. So there's a lot of things to consider. Once you start hitting $150,000 or more of net income, that's where this makes sense. We have tons of content in the Teaching Tax Flow YouTube channel, and we even have a video that equates an S corp election to going to a pizza buffet. So I'm going to challenge John right now
Oh boy,
to make sure that that reel is linked into the show notes. He's going to love this when he's editing it, but that
let's
makes
do it.
all right.
I'll find it. I'll
That's
find. I'll plug it in. I will find something to plug in here.
when you think about potentially electing to be an S corp. I want you to think about going to a pizza buffet, all you can eat pizza. You might be thinking, what in the world is this guy coming up with this example for? Well, here's why. The S corp election allows you to mitigate payroll taxes, specifically Social Security and Medicare tax. Well, if your income is low, meaning you don't have a big appetite, paying a higher amount to eat at the buffet doesn't make sense. You're not going to take advantage of that all-you-can-eat feature. Or if you already ate an hour before, even if you have a big appetite, it doesn't make sense to buy the pizza buffet. What do I mean by already ate? What if you have a W-2 job somewhere else so you've already filled up your Social Security wage base? When does the S corp make sense? When you have a big appetite and you are super hungry and you're going to get your money's worth at that buffet. That's when an S corp makes sense. When you have a ton of self-employment income and you can justify a small reasonable compensation and you don't have any other W-2 wages. So think about that when you're thinking about if an S corp makes sense.
And that S corp one, I always think is interesting, right? And maybe if we can go back, so I promise I will not put you in the hot seat and throw you any questions. Just kind of reiterating what was said here, because you're right. I mean, some people, and I've seen it happen with some content, not just ours, but anybody's, where it gets taken out of context because they have that way of thinking, like it's ingrained in them. Like, oh, I heard this on a 60-second TikTok video. That's the way I need to do it because I heard it first. And you're not saying that it's not, but I remember, a couple things you mentioned here. I think we need to just highlight again is, compliance costs. And what we mean by that, right, is there's more costs, frankly, in maintaining and doing your taxes. And then you mentioned payroll, right? And reasonable comp. You just can't say, oh, I reasonably think I should get paid $8,000 a year for being the key
Right.
man, right? Like it's not
Or,
your reasonable. It's the
I mean,
industry.
we're gonna keep going. I'll mention one more thing
Yeah.
before my blood pressure gets boiling on this. Or a situation of someone, this happens a lot in the medical profession. You have to say a medical doctor. That person's making $400,000 or $500,000 as working in a hospital system or a private medical practice, or even $200,000, $300,000, $250,000. They start moonlighting, right? They form an PLLC. They are working out of their home. They're reading charts. They're doing some telemedicine on the side. Nothing wrong with that. But then they're like, well, my buddy told me I should be an S Corp. Well, wait a second. You already filled up your entire Social Security wage base. Being an S Corp would actually cost you more money in that fact pattern than anything. So we're gonna. So yes. So
We'll move along before your head explodes.
Yeah, we're gonna move along and wrap things up because those are my really. There's tons of tax strategies for people making over $150,000, but those are going to be the first few that I would consider that are more behavioral. Like electing to be an S Corp is more behavioral. You're ultimately still in business. You're still doing bookkeeping. You're just reorganizing how you're taxed. And yeah, it might cost you more money in compliance, but it also reduces your tax. So let's move on from those behavioral, more basic or entry level tax planning implementations to a couple of things that are more, that are more tax advantage investments or tax mitigation strategies. So let's change the facts, John. Let's say instead of someone making $150,000, and maybe we might do another podcast episode down the road. Let's change the facts that someone's making $1.5 million. Okay. So obviously all those other strategies are in play. It might make sense for them to increase the amount they're putting into retirement, potentially. But what should they do once you start getting into that $500,000 or more, let's say $1 million of marginal tax or of taxable income if you're self-employed? I'll just throw a couple tidbits out there. One of the strategies is a build upon income shifting, and it's income shifting to a related business entity. A very popular strategy is called the 831B strategy, which is a private reinsurance company. We actually have an entire podcast episode just on that. So if you're a business owner, first of all, let's say you're making $1 million a year, you are living a good lifestyle, but at the end of the year, you've maxed out your retirement account and you've got $400,000 in your business account, and you really don't need that money today. And if you let it sit there and do nothing, you will pay tax on it at probably a 40% rate. That's where you could potentially deploy that into something and take it off of your tax return as taxable income. So that the 831B strategy is something to consider. The other two things would be potentially some leveraged charitable giving. We've got a whole episode on that. And then start looking at some transferable tax credits. So those, once you get to that point, you really need to be working with a tax professional that specializes in tax strategy and tax planning implementations. But yeah, and if you're in that situation, good for you. That's amazing. A lot of times when people grow to that level, their next step is let's say you own a business, you want to buy a building. There could be a huge advantage to buying a building. However, there's a misconception that says, well, if I bought a building, I was working with a client this week, the week we're recording this and filming it. Person bought a commercial building for about $1.6 million, has had to put about $400,000 of cash into renovation. So we're all in at $200,000. Has a loan for about $1.2 million. So that cash outlay is $800,000. Cash flow versus tax flow. Just because you pay cash for an improvement doesn't make it immediately deductible. The building is set up for depreciation, commercial building, 39 years. So understanding that cash flow versus tax flow, one of the other laws of teaching tax law, is super important. And before you deploy all of that cash, make sure you work with someone to understand the ramifications.
Absolutely. And we can almost kind of wrap this up with, again, going back to the beginning about the importance and really the accessibility of planning. I don't think we have to go crazy with it saying how important it is that it's there for everybody. So contact your tax pro directly, and you can reach out to us if you needed to. We even have something called the Hub at Teaching Tax Flow that, we invite everybody to check out. I mean, you're not going to go to this thing and it's not going to give you any answers. However, what it will do is it will blow up our inbox. Not really. but it will actually help us connect you with the right people. So, I mean, it's down from anything. Chris, what are some of the ones that are on there? Like attorney, somebody's needs. I need a
Yeah.
financial advisor, tax
So
professional.
some of the things when we talk about building your board of directors, right? And a lot of people hear that and say, "Man, that sounds good." So the hub's an area. It's teaching tax law /hub. John will post this link. If you're listening to this, watching this, first of all, thank you. Second of all, like this and subscribe to our YouTube channel. We appreciate it. I'm not too proud, ain't too proud to beg, as a hip hop song from the 90s once said. But so you might be out there, and actually, John, it's interesting, right? A lot of our submissions are actually from other tax professionals, and there's nothing wrong with that. We all have different skill sets, different areas we work in. But if you're looking for someone to help with a cost segregation study, research and development credits, grants, estate planning, bookkeeping, CFO services, payroll processing, tax advantage investments, mitigation strategies, financial planning, entity formation, registered agent service, real estate investor time tracking, IRS representation, tax preparation, tax planning, life insurance, and more, just jump into the hub and let us
We should
know
put
that
dog walker on there. We should put like dog walker, psychologist. But in all seriousness, and by the way, everybody who's listening to this, if you're sitting there, you're like, I'm not going to click on this thing. Be like, these guys are going to sell me and grenade me with stuff. It's there for you. It's not for us. It's not a sales tool. There's no gimmicks involved in this. We're just making it a one-stop shop. You can click multiple things and we can connect you with the best person. You don't even have to talk to anybody with us. We can just move you along. So check
Absolutely.
that out. And actually, I think what we'll do here, Chris, too, in the show notes, I have an idea. Maybe since everybody can watch these, they watch our podcast, they listen to the podcast completely free, right? There's no obligation to anybody for this stuff. I think we're going to do like in the notes here, we're going to do a 1, 2, 3 steps in there. And basically it's like the support us steps. So maybe one, it'll be, click here, subscribe to our YouTube channel. Very easy. If you're not on YouTube, then you got other issues. I shouldn't say that. You got other things going on. We'll do that. And then, we'll put some other things in there and, we'll put the hub in there, probably number 3, but maybe we'll put one more in front of it. Maybe it'll just be a question, answer a question, join our Defeating Taxes, private Facebook group, something along those lines. So that way everybody's really in tune with everything we have going out. Cause I know we got some good content too on the roster for the next couple months. So I'm glad we did this one though too, because, I think we started off at one point, we defined that marginal tax rate, kind of moved all the way through many of the strategies that we hear about, we talk about. I think if anything, hopefully we made sense of some of these for a lot of people where there's, frankly, a lot of misinformation that's out there. And really, I won't say misinformation. It's too small of nuggets of information, not telling the whole story, which is just as dangerous. So definitely check out everything else we have. Again, don't be lazy. Show notes. If you're watching this, I'm pointing down. It's literally right below here. You have no excuse not to click on those, so do it. You can't say you're trying to meet a tax deadline right now. You got a little time, so no excuses. And then we will see everybody back here next week, right? Different topic, different day, same day of the week, but completely different approach to something that we as taxpayers have to deal with every single day, whether we like it or not, 365 days a year. That little pesky thing we call taxes. So we'll see everybody next week. Make it a great one. We'll see you soon.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.